Picture a bustling young nation where fortunes were made as swiftly as they were lost, and dreams of wealth seemed to hover just beyond the horizon. This was America in the 1830s, a land of boundless opportunities and speculative fervor. Yet, beneath this veneer of prosperity lay the seeds of a catastrophic financial collapse, the Panic of 1837. Join us as we delve into the roots of this historic economic upheaval, unravel the dramatic chain of events, and uncover the long-lasting impact that shaped America's economic future. The Panic of 1837 was not just an isolated event but a significant turning point in American financial history. The crisis was marked by a sudden and severe economic downturn that stemmed from a perfect storm of speculative excess, banking instability, and controversial political decisions. The aftermath of this crisis reverberated throughout the economy, affecting millions of Americans and setting the stage for future financial reforms. 1. The pre-panic economic boom. The early 1800s witnessed remarkable economic expansion in the United States. The cotton industry, driven by the southern states, was the cornerstone of this growth. By 1837, cotton production had surged to over 2 million bales annually, a dramatic increase from the 750,000 bales produced in 1820. This cotton boom made up over 50% of all American exports, underlining its critical role in the economy. The expansion of cotton plantations and the increased reliance on enslaved labor to meet production demands were central to this growth. The banking sector also experienced unprecedented expansion. The number of banks in the U.S. grew from 329 in 1820 to 616 by 1837. These banks held approximately $1 billion in assets, compared to just $200 million in 1820. This rapid growth was accompanied by a lack of regulatory oversight, leading to the proliferation of state-chartered banks that issued paper money far beyond their reserves. The speculative fever of the 1830s was driven by a belief in unstoppable economic growth. Land prices skyrocketed as speculators bought up vast tracts of land in anticipation of future gains. In Illinois, for instance, land prices jumped from $1.25 per acre in 1830 to $10 per acre by 1836. This speculative bubble was exacerbated by the easy availability of credit, with banks issuing paper money at a ratio of 10 to 1 compared to specie, gold and silver. This overextension led to unsustainable land values and an inevitable market correction. The speculative environment was fueled by tales of rapid wealth accumulation. Investors, driven by the allure of quick riches and a lack of financial education, engaged in high-risk ventures without fully understanding the underlying risks. This speculative bubble, characterized by irrational exuberance, set the stage for a dramatic collapse. 2. Key figures and policies leading to the panic. President Andrew Jackson played a pivotal role in shaping the events leading to the Panic of 1837. His staunch opposition to the Second Bank of the United States was a defining aspect of his presidency. Jackson's 1832 veto of the bank's rec charter was a significant political and economic event. By 1833, he had withdrawn federal deposits from the bank and redistributed them to state-chartered banks, known as pet banks. These pet banks, lacking federal oversight, engaged in imprudent lending practices. They issued paper money at an alarming rate, which contributed to an unstable banking system. The removal of federal deposits and the consequent distribution to less regulated banks created a volatile financial environment that was ripe for collapse. In an effort to control speculation, Jackson issued the Specie Circular in 1836. This executive order mandated that public land purchases be made in gold or silver rather than paper money. While the intention was to stabilize the economy by reducing reliance on inflated banknotes, the immediate effect was severe. Banks faced a liquidity crisis as they struggled to meet the demand for specie. By early 1837, a wave of bank suspensions swept through the country. In New York, 34 out of 40 banks halted operations, creating a severe credit crunch and exacerbating the financial turmoil. 3. The collapse, triggering the panic. The Panic of 1837 was marked by a cascade of bank failures. By the end of the year, over 200 banks had failed, and the amount of available credit fell by 30% in just a few months. Major financial institutions, unable to cope with the withdrawal of deposits and the collapse of their reserves, went bankrupt. This led to a severe credit crunch, where businesses dependent on credit for operations found themselves unable to secure necessary funds. The ripple effects of the banking collapse resulted in widespread bankruptcies and financial distress. The economic collapse had profound effects on both businesses and individuals. Large-scale enterprises involved in land speculation, such as the Mississippi Land Company, faced financial ruin. Farmers, who had borrowed heavily to expand their operations, were unable to repay their debts, leading to widespread foreclosures. By 1839, unemployment rates had soared to around 30%, with major cities like New York and Philadelphia experiencing increased poverty and homelessness. Soup kitchens and charitable organizations became essential as many struggled to make ends meet. Over 200 banks failed by the end of 1837, representing nearly one-third of all banks in the country at the time. Unemployment surged to approximately 30%, a significant increase from the pre-panic rate of around 8%. Land foreclosures and farm bankruptcies became rampant, with an estimated 10,000 farms lost to foreclosure by 1839. 4. The aftermath, economic depression. The depression following the Panic of 1837 was deep and prolonged. Unemployment rates remained high, and poverty became widespread. Major cities saw a rise in homelessness, with makeshift shantytowns emerging as symbols of economic despair. Industrial output declined significantly, and economic activity slowed across the country. The impact on daily life was severe, with many Americans struggling to survive in the face of widespread economic hardship. In response to the crisis, President Martin Van Buren introduced the independent treasury system in 1840. This system aimed to stabilize the economy by separating federal finances from private banks. The independent treasury system established a network of federal depositories to manage government funds independently of the banking system. While this policy helped restore some stability, the recovery was slow and uneven. The economic landscape remained challenging as the country dealt with the fallout from the panic. The system established 15 federal depositories across major cities to manage government funds. The recovery took nearly a decade, with GDP growth rates remaining below 2% annually until the early 1840s. Agricultural productivity and the expansion of railroads played crucial roles in the recovery, with rail mileage increasing from 1,000 miles in 1837 to 3,300 miles by 1843. 5. Recovery and long-term impact. Recovery from the Panic of 1837 was a gradual process, marked by significant improvements in agricultural productivity and the expansion of infrastructure. The railroad network expanded from 1,000 miles in 1837 to 3,300 miles by 1843, facilitating economic growth and connectivity. Manufacturing also saw a resurgence, contributing to a slow but steady recovery. By the early 1840s, the economy began to stabilize, though the effects of the panic lingered for years. The Panic of 1837 highlighted the need for effective banking regulation and prudent monetary policy. The crisis underscored the dangers of speculative bubbles and the importance of maintaining a stable financial system. Lessons learned from this crisis influence future economic policies, leading to the development of regulatory frameworks and financial oversight mechanisms that aim to prevent similar crises. The experience of the Panic of 1837 contributed to the eventual creation of more robust financial regulations, including the establishment of the national bank system in 1863. The crisis emphasized the need for regulatory oversight, leading to reforms aimed at stabilizing the financial system and preventing excessive speculation. 7. Comparisons with later financial crises. Parallels with the Great Depression of the 1930s. The Panic of 1837 and the Great Depression of the 1930s share striking similarities in terms of their causes and consequences. Both crises were precipitated by speculative bubbles and unsound financial practices, resulting in widespread economic hardship. The Great Depression, like the Panic of 1837, was characterized by a severe downturn in economic activity, a wave of bank failures, and a significant increase in unemployment. Just as the 1830s saw reckless land speculation, the 1920s experienced stock market speculation fueled by easy credit. Both periods were marked by an overextension of financial resources and an overestimation of economic stability. The Panic of 1837 saw the collapse of numerous banks, a trend mirrored by the bank failures during the Great Depression. In both instances, these failures led to a severe credit crunch and contributed to a broader economic collapse. The economic crises led to high unemployment and widespread poverty. The Great Depression saw unemployment rates peak at around 25%, while the Panic of 1837 resulted in an estimated 30% unemployment rate in major cities. While there are notable similarities between the two crises, the responses and recovery strategies differed significantly. The Great Depression led to a series of far-reaching reforms under President Franklin D. Roosevelt's New Deal, which included financial regulations, social safety nets, and public works programs designed to stabilize the economy and provide relief to those affected. In contrast, the recovery from the Panic of 1837 was slower and less organized. The independent treasury system, while stabilizing government finances, did not provide the comprehensive economic reforms seen in the New Deal. The recovery relied more on gradual economic adjustments and the eventual expansion of infrastructure and industrial capacity. New Deal reforms. The New Deal included measures such as the Banking Act of 1933, which established the Federal Deposit Insurance Corporation, FDIC, to ensure deposits and restore public confidence in the banking system. The New Deal also saw substantial investments in infrastructure, such as roads and public buildings, which provided jobs and stimulated economic activity. This approach was more proactive compared to the gradual recovery witnessed after the Panic of 1837. The impact of modern financial regulation. Modern financial regulation has evolved significantly since the early 19th century. The lessons learned from historical crises like the Panic of 1837 have informed contemporary regulatory frameworks designed to prevent similar disasters. Key developments include institutions such as the Federal Reserve, established in 1913, and the Securities and Exchange Commission, SEC, created in 1934, play crucial roles in overseeing financial markets and ensuring stability. Modern regulations include measures to enhance financial stability, such as stress tests for banks, capital requirements, and oversight of financial instruments to mitigate risks and prevent speculative bubbles. 8. Conclusion: reflecting on historical lessons. The Panic of 1837 serves as a poignant reminder of the dangers inherent in speculative excess and unregulated financial practices. The lessons from this early financial crisis have shaped the evolution of American economic policy and financial regulation, influencing the response to future crises and contributing to the development of a more resilient financial system. As we reflect on the impact of the Panic of 1837, we gain valuable insights into the importance of sound economic principles, prudent regulation, and the need for vigilance in maintaining financial stability. Understanding these historical events not only helps us appreciate the progress made, but also reinforces the ongoing need for careful oversight and informed decision-making in the realm of finance. Thank you for joining us on this journey through America's first Great Depression. If you found this exploration insightful, don't forget to like, subscribe, and hit the notification bell to stay updated on our latest videos. Share your thoughts and questions in the comments below. We'd love to hear from you.